Good morning, everybody. Welcome to our Autumn Statement webinar. My name is Liam O'Doherty. I'm a tax partner based in the Northwest, and I'll be your host today. If we go on to the next slide, please. Our agenda will encompass an economic overview, and then we'll review the key areas that have changed in yesterday's statement. I'll pick up on business taxes. Caroline's going to pick up on employment taxes, Martyne on indirect taxes, and Ben on personal taxes. And we'll round off with some questions at the end. In terms of admin, feel free to use the Q&A facility as we go along, and we'll pick up those questions at the question session at the end. So without further ado, I'll pass you on to Sam, who's going to provide the economic update.
Good morning, everyone. I'm Sam Miley from the Centre for Economics and Business Research. I'm here today to give a brief overview of the current state of the economy and some of our projections for the coming months and years. Next slide, please. So to begin with, I'll lead with the continual hot topic of inflation. The latest data from the Office for National Statistics revealed a significant slowdown in the rate of price growth in October, coming in at a rate of 4.6%. Now, this is quite a stark reading when compared to the double-digit inflation that we were facing in early 2023, confirming that we are firmly on a downward trajectory when it comes to price growth. The October reading marked the slowest rate of inflation for 2 years, with the main downward contributor being energy prices, which are now much lower than they were this time a year ago. In terms of the outlook for inflation, we are anticipating a further slowdown in the rate of price growth for the rest of the year and indeed into 2024 and beyond. Nevertheless, as I'll come on to later in my presentation, there are some risks to the inflation outlook, which mean that on the whole, we are anticipating price growth to remain above the Bank of England's target rate of 2% for some time. Indeed, we don't anticipate a complete return to target until around 2027, which is a slightly more pessimistic view than that presented by the OBR in their report accompanying yesterday's autumn statements, wherein they are predicting a return to target by 2025. Next slide, please. Moving away from inflation towards a discussion of the labour market, this slide shows the UK unemployment rate over time. In the near term, we have recorded a series of slight upticks in the unemployment rate, with the latest data showing a rate of 4.2% in Q3 of this year. It's important to note that this is still a historically low level of unemployment, certainly in comparison to around this time 10 years ago, when the labour market was still in a relatively weak position post-financial crisis. Nevertheless, it is up on the quite historically tight readings that we saw in 2022 and earlier in 2023, indicating that the labour market is beginning to somewhat loosen. Looking ahead, we expect the unemployment rate to continue on a slight upward trajectory, reflecting the effects of some broader economic headwinds that I will touch on later in the presentation. As a result, we expect the unemployment rate to reach a peak of just over 5% in mid-2024 before returning to a downward trajectory. On the unemployment rate, it is important for us to note that recent figures from the Office for National Statistics have actually been subject to a greater degree of uncertainty due to some methodological difficulties with the sampling processes. And this is making assessments of the labour market using traditional metrics like the unemployment or employment rates a slightly more difficult task at the moment. Next slide, please. As a result of that difficulty with interpreting the more traditional labour market metrics, economists are now relying more heavily on alternative indicators to assess labour market health. And one of the strongest such indicators, in our opinion, is looking at the number of vacancies across the economy as a whole, which can be interpreted as a proxy for the hiring intentions of employers. And what we see here is that we have firmly passed a turning point on this metric. The number of vacancies really did soar in the aftermath of the pandemic and the subsequent reopening of the economy. But we've since seen the emergence of a downward trend, which has persisted into 2023 and is expected to continue, indicating that employers are less robust in their hiring intentions. Next slide, please. Another alternative indicator to assess the health of the labour market is to look at earnings growth. And this has been quite an interesting indicator for a number of years now, with a real divergence between trends in nominal and real terms. Beginning with nominal growth, which is represented by the green line on this chart, we have seen historically elevated levels of earnings growth for some time now. This has been driven by a number of factors, including the previously historically tight labour markets, the general inflationary environment, and a variety of policy changes. Nevertheless, despite this quite elevated wage growth in nominal terms, the rate of price growth has exceeded this for many readings in recent years, meaning that in real terms, wages had been falling. Nevertheless, we have now recently seen a return to growth in real terms as a result of the general slowdown in inflation and the continually elevated rate of nominal earnings growth. This means that spending power is now returning to positive growth across the economy. Looking ahead, though, we do expect earnings growth rates to subside somewhat into 2024, albeit remaining at relatively elevated historic levels. Next slide, please. As mentioned in my previous slide, the rate of real earnings growth has returned to positive territory in recent months. And this is one factor behind a general improvement in consumer sentiment across the economy. Here, the chart presents CBR's Consumer Confidence Index, which we produce alongside YouGov. And just for ease of interpretation, the dotted line at 100 indicates net neutrality amongst consumers, which can be interpreted as equal sized populations expressing positive sentiments surrounding the economy and negative sentiments. As such, any value above 100 indicates net positivity, and the opposite for values below 100. What we've seen is in the aftermath of or as a consequence of the cost of living crisis, there was a real sharp downward trajectory in confidence across 2022 and into early this year. Nevertheless, there has been a partial rebound here, with consumers now becoming more secure in their sentiment surrounding the economy, inducing positive readings on this metric. It is important to flag that this indicator is itself comprised of 4 different categories, where we ask consumers about their sentiment on household finances, on property values, on general business activity, and general job security. And although the headline metric is now trending positive, there is some firm divergence across those four categories, with consumers notably being negative on household finances and near-term job security, but generally still positive on property prices and general business activity. Next slide, please. I mentioned earlier in the presentation that the economy is set to face some pressure in the near term, driven by a number of headwinds. And arguably the most important of these headwinds is the currently tight monetary policy environment. So if we cast our minds back to this time around 3.5 years ago, we had the loosest monetary policy possible, effectively, with a Bank of England base rate of just 0.1%. Since then, we have obviously had a significant inflationary spike, which has prompted the bank to implement quite an aggressive rate hiking cycle, leading us to the present day, where we have an interest rate of 5.25%. We do expect rates to have reached a peak. We expect the rate of 5.25% to persist until around the middle of next year, at which point we expect the bank to cut quite sharply for a number of monetary policy meetings before entering a more gradual cutting cycle into the mid-2020s. I think the main point to flag here is that the long-term path for interest rates beyond the horizon presented in this chart has the base rate trending at around 2%, which, while normal in historic terms, is a lot higher than the loose monetary policy that the economy had arguably got used to in the 10 years or so prior to the bank's recent hiking cycle. Next slide, please. Here we have a chart depicting the growth rate of the UK economy over time and projections, our projections for 2023 and the subsequent 3 years. In terms of this year and next, we expect the economy to have shown some quite weak performance in terms of growth, driven by headwinds, including the tighter monetary policy described on the previous slide, but other effects such as continued supply chain pressures and pressure on the consumer side of the economy from elevated inflation and reduced spending power. On the whole, we anticipate growth for this year to come in at just 0.5%, which would be a significant slowdown on last year's rate, which was in excess of 4%. Looking ahead to 2024, we are projecting an even weaker growth rate of 0.4%, before an uptick in the remaining years of the forecast horizon. It's important for me to flag here that within the 2023 and 2024 forecasts, we are anticipating the economy to experience a mild technical recession marked by 2 consecutive quarters of economic contraction. Next slide, please. Here I present our forecasts for output growth amongst various key sectors in the economy. And while the aggregate level growth forecasts depicted on the previous slide show quite weak growth in both 2023 and 2024, there is significant sectoral divergence within this figure. If we begin with forecasts for this year, some of the strongest expected performers include administrative and support activities and the information and communication sectors. These 2 sectors are examples of industries that are less exposed to ongoing economic headwinds, first of all being less exposed to consumer side pressures, but also the supply side difficulties that have plagued other industries. Looking ahead to 2024, the picture is of continually strong growth in information and communication, as well as above average growth in other services sectors such as transport and storage, finance, and professional services. At the other end of the scale, we are expecting both the real estate and construction sectors to experience quite sharp economic contractions next year, with these two sectors being arguably the most exposed to the interest rate headwind described previously. Next slide, please. This slide replicates the previous one, but looking at regional output forecasts rather than sectors. Here we have a relatively more uniform picture, but still some notable divergences to draw out. I think the main point here is that London is expected to be the UK's strongest performing region economically when looking at both this year and next year, which is of course rather at odds with some of the policy sentiment regarding levelling up and improving economic outcomes in other parts of the UK. At the other end of the scale, the Northeast is expected to be the weakest performer in 2023 and 2024, with this region being particularly vulnerable to consumer side pressures due to the already generally weaker standards of living in this region. Next slide, please. A final slide from me today with some economic interpretation of key policies announced at yesterday's autumn statement, which admittedly was quite light on meaningful economic policy. One of the key takeaways, however, was the cut to the contribution rate on national insurance, which we expect to have both demand and supply side effects on the economy. Looking at the demand side, it will increase the take-home pay of workers, and with that may encourage greater consumer expenditure. Meanwhile, on the supply side, there is a marginal effect on providing greater incentives to work, which may entice people on the margin back into the labour market. Similar economic effects could be described for the rise in the national living wage and the expansion of eligibility. Meanwhile, looking away from those labour market targeted effects to the social security space, the uprating of the universal credit payments in line with inflation will help to limit the extent to which living standards of recipients are eroded by inflation. Moving away from consumers to the business side, the other main takeaway from the statement was the making permanent the full expensing of capital allowances, which we expect to boost capital investment in the long term by providing potential investors with greater levels of certainty. Meanwhile, the planning policy changes will be useful to alleviate some of the blockage to housing and infrastructure investments, but arguably have not gone far enough to completely alleviate the holdup in that space of the economy. With that, I'd like to thank you for listening and hand over to colleagues at BDO.
Thank you very much, Sam. Very interesting. If I could go to the next slide, please. I'm going to pick up business taxes, and the message here is very similar to that of last year's budget, in that sort of there are no rate changes at all, and the kind of narrative is very much around the contribution of reliefs and stimulating investment. Go to the next slide, please. First relief is to look at is capital allowances, and obviously the full expensing mechanic was made permanent. It was announced last year to have a life of 3 years, and the Chancellor put great store on the fact that making this permanent was, in his view, the single biggest thing he could do to stimulate investment in the country. So that's a sort of a welcome change. If we go to the next slide, please. One of the other key reliefs that we have in the economy is R&D, and it's obviously been quite a controversial area over the last number of years. There's been a perception, particularly in the SME space, that there's been a lot of fraud in the sector, and there's been a whole series of reforms. The bottom left-hand corner of that slide sort of runs through some of the reforms that we've already had, the last of which is sort of overseas costs ceasing to qualify for R&D, will come in from 1st of April 2024. But the big area we were all really holding our breath for around sort of this autumn statement was whether they would actually go through with their plan to merge the SME and large company sort of R&D schemes at April 2024. That had been flagged last year. There'd been sort of a number of commentators, including ourselves, lobbying for a deferral of that merger potentially to April 2026. The message from the autumn statement yesterday is that would, at least for now, go ahead at April 2024. If we go on to the next slide, we can see what that means in terms of rates. Effectively, for profit-making companies, the rate of relief is going to be harmonised around the lower sort of RDEC regime. So for a profit-making business that has £100 of R&D, they would get sort of a benefit of £15. Slightly better news for loss-making businesses in that the benefit would be 16.2, which sits somewhere between the SME sort of rate and the RDEC rate. But if one looks back to 2 years to prior to the 31st of March 2023, for an SME, they would have received a subsidy of 33.4, and that's coming a long way down to that 16.2. You will recall last year, partly because of that sort of very substantial impact on loss-making SMEs, in particular knowledge-intensive SMEs that were potentially going to deliver a lot of growth to the economy in years to come. If you look on the right-hand sort of column, there was a new sort of subsidy or regime introduced for these knowledge intensive companies, and they could that were loss-making, and they could sort of generate a subsidy of 26.97. Now, the definition as of April 23 to be knowledge intensive is more than 40% of your activities need to be R&D. There was a change announced yesterday that sort of a benchmark to get into that regime has come down to 30%, and that's from April 2024. So that's another welcome change. If we could move on to the next slide, please. Looking at a little bit more detail around the merger of those two schemes and the detail that's come out. Obviously, there were different rules for the large company scheme and from the SME scheme, and there was a lot of interest in how they were going to be harmonised and who the winners and losers would be. The good news overall is that so far the kind of harmonisation tends to have worked in the favour of the taxpayer. So a couple of examples for that. There was a cap on the repayable relief for loss-making companies, and that has been sort of harmonised around the more advantageous sort of SME scheme rules. And another example of a benefit for SMEs, previously SMEs weren't able to claim sort of R&D on subsidised expenditure. So if they received grant income going towards R&D, that would have restricted a claim. It didn't for large businesses. And actually, it's the large business sort of regime where grant income doesn't sort of impact on R&D, which is going to be sort of the norm going forward. One significant area where we're still waiting to understand sort of how the harmonisation will take place, that's around subcontracted work. SMEs had been able to claim for subcontracted work, large companies couldn't. So we're waiting on that one. But generally speaking, it's also worth noting that there's a little bit more admin around the claim and accounting for SMEs going forward. One other area to note, not directly linked to the merger, but it was announced last October that HMRC have 13 expectations around any sort of R&D claim. for that claim to be properly compliant. And that's quite a good segue into our first poll of the day. Natalie, I don't know whether we can get the poll up. So if you could click on there, it's a question and we'll give some instant feedback on the results. How confident are you that your R&D claims and documentation meet HMRC's 13 expectations for a claim? So I'll just give you a little bit of time to answer that, and then I think we can get some instant feedback on what the answers have been. So Natalie, if you bring the answers up whenever you're ready. Okay, so fairly mixed results there, but edging on the side of being more confident than not. So that's interesting. If we could close that and go on to the next slide. So the next slide is just looking at areas where business investment is being stimulated, and it was really quite striking from the Chancellor's speech how many initiatives there actually were. I think he sort of totted them up and sort of counted that there were 110. What we've tried to show on that left-hand column there is all the initiative areas that have been sort of set out in the documents. There are too many to sort of feature every sort of initiative. But I think what those broad areas that have been identified sort of indicate is just quite how broad those 110 areas are, that there is not sort of a decision to focus on a very narrow area and really say that that's the way forward. They've gone for a kind of a very broad brush approach. It is interesting to pick out that there is a refocus on manufacturing that perhaps hasn't been in some previous budgets. And the other interesting couple of areas to pick out would be investment zones. The time period for the relief in those investment zones has been extended from 5 to 10 years. Obviously, breaks around rates, NIC on new jobs and capital allowances in those areas. Similarly, Freeport's tax relief has been extended into September 2031, and new investment zones have been named in Manchester, Birmingham and East Midlands. Finally, around investment, there were new pension fund investment rules announced, and alongside that there's a new fund that's going to be launched and operated by the British Investment Bank. And what that is effectively will do, there are a number of the larger pension funds have been lined up to contribute significant funds into this new fund, and that will be used to invest and lend to high growth businesses. And the thought is that can stimulate both the economy, but also sort of give us all a better return in our pensions. So it'll be interesting to see how that actually works out in practice. And I think at this point we've got our second poll, which factoring in sort of that sort of very broad range of investment motives, and of course remembering the sort of the Chancellor's sort of commitment to make capital allowance expensing permanent. The question is, have all those announcements, are they more likely to make your business make major investments in the next 2 years or not? And again, if you kind of answer that one, we'll give some instant feedback on the answers. Again, Natalie, whenever you're ready, if you want to get the answers up. Yeah, that's interesting. The resounding message of none of the changes won't change anybody's plans. So yeah, interesting that. If we could move on to the next slide. Couple of other, if we could just remove that, the poll results. Couple of other announcements in the budget. or things that were confirmed. Obviously, Pillar 2 will take effect from the 1st Jan 2024. That is a minimum tax rate of 15%. Globally, obviously only applies to businesses with a turnover of more than 750 million. And those that fall into that category will probably be well ahead with their plans on that. Natalie, are you able to sort of just remove the business poll sort of slide? On Pillar 2, that there's still Pillar 1, there's still debate as to how that will be implemented. And there were a number of other changes yesterday around making REITs more competitive and sort of extending the sunset clauses for EIS and VCT. The other change that there was is that the ATED charges were just increased in line with the Consumer Price Index. If we go on to the next slide. Finally, there was a package announced in relation to sort of business rates over the next 5 years, principally aimed at the retail, hospitality and leisure sector. The 75% relief, which was a hangover from COVID, has been extended for 1 more year. And the freezing of the multiplier it's been frozen effectively for the 4th consecutive year, and the standard multiplier will mirror inflation. So some positive news there, particularly for the retail, hospitality and leisure sectors. So that's all really there was on the business section. So without further ado, I'll hand over to Caroline, who's going to talk about employment taxes.
Thank you very much, Liam. Good morning, everybody. The Chancellor's Back to Work plan formed the final third and theme of the statement yesterday, which is very exciting for me as I head the employment taxes practice for BDO nationally. Next slide, please, Natalie. Is it a bold combination of carrot and stick? Well, the headlines you'll have seen immediately after the autumn statement yesterday focused on the carrot element, which is made up of the national insurance savings and the increases in national living wage, which Sam has already touched on. I'm going to turn first to the package of measures which are going to be implemented to support individuals back into the workplace. If we look at ONS data, there are around 300,000 people who have been unemployed for over 12 months. Now, that's a fifth of the total UK unemployed population. And the longer you are unemployed, the harder it is to return to work. So we've got a skills gap, we've got a pool of long-term unemployed people, and the Chancellor has announced a targeted set of measures to tackle this issue, that's focusing on those who are claiming universal credit. So it includes the provision of job centre support. There'll be coaches who will be supporting claimants with the skills that they need to get a job, so writing CVs, how to present themselves, etc. After 6 months, if they still haven't succeeded in finding a placement, there's a 12-month period of an enhanced and improved restart programme. And if they still haven't got a job, then at the end of the 18-month period, the individual will be required to take up a mandatory work placement. Now, for us as employers, it'll be interesting to find out what that will mean in terms of people that we will be taking on. And if that's not sufficiently enticing to the claimants, then if they still refuse to try to get a job or to take up the mandatory work placement, at the end of that 18-month period, their universal credit claim will cease, that will be stopped. So making work pay, the contrary is not working, not paying. So that's the targeted measures with regard to universal credit. Looking at those who are disabled or long-term sick, putting that in the context of changes to the way we work, particularly following the pandemic and the ability now to work at home much more easily for many, there'll be a package of measures which will cost about 1.3 billion over the next 5 years, aimed at helping the long-term sick and the disabled back to work. So there'll be 795 million focusing on those with mental illness, with talking therapies and other forms of support. And there'll be an end-to-end reform of the fit note system. So for employers, we're really going to need to understand what that's going to mean to us. It's going to focus on treatment options and enabling work, and occupational health will become ever more important in making sure that we do the right things in the workplace to support those coming back to work with long-term health issues. Really important for us to to follow those reforms as they take shape. Now, last bullet on this page, the counterpoint is that to make work pay, there'll be a significant increase in national living wage, which will take effect from April 2024. Those who are aged 21 or 22 now are paid at the same rate as those aged 23 and over. And I know some of my compatriots with university students working in bars know that their children are very excited and have worked out how to spend their 12.4% increase already. And that's a 9.8% increase for the older age bracket. Those aged 18 to 20 get a 14.8% increase to £8.60, and apprentices and those under 18, apprentices under 19 and individuals under 18 get an increase of 21.2%, with their NLW payments rising to £6.40 per hour. Now, that's extremely good news for those who are on the national living wage. But what it does mean is for those who employ a higher proportion of lower paid workers, it's going to be a significant increase in the base cost of employing people. Team that with the really complicated nature of the national minimum wage, national living wage rules, and you're potentially exposed to inadvertently underpaying. So as an employer, you need to focus on the typical areas where you can fall foul of the national minimum wage rules despite having really carefully set out policies and procedures. You may find that some business units might fail to record working time correctly. They may not record their breaks. They may not correctly time starting work and finishing work. You may find that your workers are incorrectly categorized. The difference between salaried worker and timed worker is not intuitive. It's very complicated. And there can be misunderstandings about the types of deductions from pay that reduce pay as defined for national living wage purposes, particularly salary sacrifice schemes, issues such as living accommodation, uniforms, required clothing. Make sure that you're on top of all of that. So review your policies and your procedures and how they're actually operated in practice to make sure that you're fully compliant before those rate increases come into effect in April, 1st of April 2024. Next slide, please. So the other main headline, and the ones that lots of people have been waking up to this morning, is the decrease in the NIC rates. So you've got a 1% reduction from 9% to 8% in the main rate of Class 4 NIC for the self-employed, alongside the abolition of the weekly flat rate Class 2 NIC, which would have risen to £3.70 in April 24. And you'll hear more on this from Ben in a minute. The main rate of employees Class 1 NIC will be reduced by 2% from 12% to 10%, which gives you a maximum saving for employees owning over 50,270 of up to £574 per annum. That's £14.50 per week. So that's quite a significant amount of money for many. And the key point for employers to note is that whilst we might have expected these changes to take place from the 6th of April 2024, they're actually going to be in place from the 6th of January 2024. Now, with the upcoming festive season, that doesn't give employers an awful lot of time to get their systems in place. So make sure that you speak to your payroll providers or look at your systems to ensure that your reduced rate of NIC will be effective from the 6th of January 2024. Next slide, please. So we have some anti-avoidance measures which have been reduced, and you can see the potential savings that the Exchequer is predicting from reforms to the construction industry scheme. These are targeted at combined VAT CIS fraud, and there was a consultation that took place in July 23. The Chancellor has now confirmed that VAT compliance will, from the 6th of April 24, be included in the statutory compliance obligations for subcontractors in order for them to apply for and to maintain gross payment status, or GPS. It's a welcome measure, but you've got to note that if you already hold GPS, compliance or otherwise with the VAT obligations only applies from the 6th of April 24. But for those who are applying and obtaining GPS on or after that date, HMRC will look back for 12 months preceding application. And that can include a pre-commencement period, and that's going to be problematic in terms of how it's operated. The measure also extends to the immediate cancellation of gross payment status if HMRC has got reasonable grounds to suspect that the holder has fraudulently provided an incorrect return or incorrect information in respect of VAT, corporation tax self-assessment, income tax self-assessment, and PAYE. There are more welcome changes, and that removes from the scope of CIS the majority of payments from landlords to tenants. So subcontractor registrations won't be required in these circumstances going forwards. Other changes include the reduction from 12 months to 6 months review following GPS being granted, and there's an introduction of a digital application for CIS registrations. Now, so long as that platform is safe and secure, it should be more effective, and it will let us chase HMRC for responses if they're tardy in getting back to us. Next slide, please, Natalie. So why are we looking at company car benefits? I think with the run up to net zero, it's important to notice actually there's no change. So we know what the planned increases are in the benefit in kind charges for electric and ultra low emission vehicles. It's going up from 2% to 3% of the list price from April 2025, but that still is very cost effective as the provision of a benefit. Van benefit, car and van fuel benefit charges for non-electric and ultra-low emission vehicles are scheduled to rise from the 6th of April 2024 in line with CPI, so just keep an eye on that. And just bear in mind that with the exemptions from the optional remuneration rules, salary sacrifice to put in place an electric vehicle company car scheme has significant benefits both for employers and employees. So if you're looking at your car fleet and you're considering electric vehicles, look at salary sacrifice as a potential option for how to provide it. Next slide, please. So in terms of other changes, we've got a very welcome change, which we've actually been lobbying for at BDO for quite a while now, in terms of the off-payroll labour rules. So if an individual is subcontracting, providing services to an engager, and the engager is required to operate PAYE, if there is a failure at some point in the chain, it goes up the chain to the end client, and the end client becomes the deemed employer and responsible for PAYE, even if they're not making the payment to the individual. So going forward, the liability of that deemed employer will be reduced for tax and NIC paid by the worker or the personal services intermediary through which they provide their services in order to meet that liability. So it's avoiding double tax. If the worker has paid tax or their intermediary has paid tax, you can set that off against the PAYE liability of the engager or end client. Now, what you do need to be aware of is that it's unlikely to meet that liability in full, because typically, whilst PAYE will apply to all of the deemed payment to the individual, if they're paying themselves to their personal services intermediary, if it's a company, they'll probably pay themselves a lower salary and take the balance in dividends, with dividends not being subject to NIC and corporation tax being operated at a lower rate than income tax. So in terms of timings, the offsets are available for settlements agreed after the 6th of April 2024, but will then apply retrospectively back to historic assessments. So for public sector, that goes all the way back to the 6th of April 2017, and for private and third sector employers, we'll be looking back to the 6th of April 2021. So if you're currently looking at this issue with HMRC, look at whether your settlement can actually be agreed after the 6th of April 2024. And HMRC are actually offering this following the suggestion in the consultation. So that is definitely something that's worth thinking about. We have a very useful change as well in terms of the admin around option grants under enterprise management incentive schemes. Now, EMI, if you qualify for it, offers the most tax effective way of providing equity incentivization to your workforce. And previously, the time limit within which you had to notify HMRC of the grant of EMI options was 92 days following that date of grant. Now, if you made multiple grants in a year, that became very complicated in terms of filings to HMRC. And the move of that notification date to the 6th of July which aligns with all the other reporting for employment-related securities and other forms of share option, is a very welcome administrative easement. And finally, to end on another welcome note, there was an exemption in 2023, 2022, 23, 23, 24 for employers' NIC relief for war veterans, and that has now been extended for a further 12 months to the 5th of April 2025. Next slide, please, Natalie. And with that, I will be handing over to Martyne Pearson, who's going to cover indirect taxes. Thank you.
Thank you, Caroline. Next slide, please. So on the face of it, for indirect taxes, there's no significant change. A lot of talk in the press around the need to introduce a VAT rate deduction following earlier years where we've seen this just before Christmas, but again, no change. And actually, when we look at the VAT gap, it's no surprise that there hasn't been a reduction in the standard rate of VAT, because the VAT gap has significantly increased 1 billion to 8.8 billion this year. So for those who are not aware of what the VAT gap is, it's the difference between what VAT is actually paid to the government versus what the government expects to receive from taxpayers. So quite a big difference. Next slide, please. So whilst no significant change, the devil is often in the detail, especially for indirect taxes. So we have seen some measures and some good measures coming through in the autumn statement. So a reduction in VAT from 20% to the 0 rate for women's sanitary products. So we're now able to apply the 0 rate to reusable period underwear from the 1st of January 2024. And we've also seen HMRC look at the 0 rate again for energy saving materials. So looking to increase the 0 rate for other technologies such as water source heat pumps, as well as reintroducing the 0 rate for energy saving materials installed in buildings solely used for charitable purposes. Like I say, very niche improvements in respect of certain areas. Another hot topic, which we see in the press quite a lot from an indirect tax perspective, was the retail export scheme. For those that have been following the news around this, it was withdrawn as a result of Brexit, post the Brexit period. A lot of retailers have been lobbying the government and Treasury to reinstate the arrangement that we had in place for exports in the retail sector, but no good news this autumn statement, albeit HMRC and the government have said that they will continue to accept representations from the industry and to look at the information carefully alongside border data. So no change for the retail export scheme. One interesting movement again is around the VAT treatment of private hire vehicles, again incredibly niche in respect of the wider tax position. HMRC are looking to consult on the VAT treatment, which has arisen post the Uber case. For those who have not been following that particular case, it really looks at whether Uber was acting as an agent or a principal in the supply chain. And it came out in respect to the cases that they should be a principal, which significantly increases the amount of VAT that needs to be paid. So I think this measure is really looking at, HMRC are going to have a look at it again next year, because they know that the playing field is not very level in respect of other operators operating in this market. It'll be interesting to see whether this has a significant impact for consumers and whether the pricing for private hire will be impacted by any change that may come in next year. Next slide, please. Plastic packaging tax, so an increase in respect of the current rate that applies for the taxation. And for those that are not aware of what plastic packaging tax is, it's a tax on new and imported plastic. And really the aim of the government is to try to encourage the use of recycled plastic rather than newly formed plastic. So it's a environmental measure. So we've got an increase in respect of the price per tonne that's payable to HMRC off the back of the autumn statement. Alongside that, we've got a very niche area of rebated oil. It looks like this measure has come in, so we're really looking at the what type of machines are able to use red diesel, and this change really comes in to correct something that was changed almost by accident in the April 2022 budget. So if you're involved in that sector, something to have a little bit of a look at. Next slide, please. The last three things to mention really, one's around tariff suspensions. So this is good news for business. So the government has decided to retain 2,000 tariffs, customs tariff suspensions on imported goods, and are looking to extend the relief for 5 years rather than the current 1 year that was originally envisaged. So again, if you're looking and you do import goods into the UK, it's definitely worth looking at the detail behind this announcement. The second from last thing I'm going to talk about is remote gambling. So what the government are looking at here is simplification of the tax rules. So at the moment, there are a number of different ways in which we tax remote gambling. So this is gambling offered over the TV, internet and radio. And what they're looking at here is to offer consultation up in the new year, really around whether they should be looking at putting a single tax in place to tax these operators in respect to the revenues received. Finally, the last thing I'm going to talk about is HMRC are going to be looking at technical consultation on how we should be looking at VAT and excise law in the post-Brexit period. So prior to Brexit, we were very much heavily reliant on being driven by EU law and the EU law principles. And now it's been a few years post that happening, they've decided that they need to have a look at how do we review the UK position in light of the removal of the UK from the European Union. So it'll be interesting to see what comes off the back of that, because we have been seeing small changes that have been happening from HMRC in respect to selecting case law that is beneficial based upon UK principles. So it'll be interesting to see where they go with that. Next slide, please. So as I say, a very, very quick view of the indirect tax piece, no significant changes, but some very niche areas that we would encourage you to have a look at if you are operating in those sectors. And now I'm going to hand you over to Ben Handley, who will talk to you about personal taxes.
Thank you, Martine, and good morning, everybody. Next slide, please. So got an awful lot to get through over the next 7 minutes or so. So I'm going to bring you up to date all the changes on income tax rates and relief, capital gains, inheritance tax, ISA saving limits, pension annual allowances, tax efficient investments, and national insurance, of course. So hopefully we'll have time to get through this. So next slide, please. Income tax rates and reliefs, no change. Capital gains, no change. I'm being glib, of course, but obviously there was very little really to report in yesterday's autumn statement from a personal tax perspective. For me, it was a bit like I'm a football fan. It was a bit like transfer deadline day, when you start to feel the rumours a week out that the best player in the world is going to sign for Liverpool, but then come transfer deadline itself, there's a few loan moves of reserve team players and so on. Caroline did say I was going to say more on the national insurance. I'm really not going to say that much more on national insurance. So for the self-employed, that drop in for those earning between 12,500 and 50,270. I think the scrapping of the class 4 and the reduction from 9% to 8%. Sorry, the class 2 and class 4 get it up, but I think it's around about £550 a month saving there. So there was, let's say no rates changes as well. A couple of things in the background, some things around making tax digital for self-assessment, which is sort of coming in the next couple of years or so. So from 2024, there's going to be those kind volunteers who are going to volunteer to report by digitally self-assessment, and they'll also benefit from the new, apparently more favourable penalty regime as well for those volunteers. You know, I personally want an amnesty if I'm trying something out as opposed to more favourable, but that's coming as well. And then from 25-26 year, they've also said some changes around the data that's collected from HMRC. And interestingly, for sort of owner managed businesses, it looks like there's going to be a requirement to report what percentage you own in a private business and where you receive dividends, separating out those, you know, what those dividends you receive from your own company versus those from other portfolio investments and so on. EIS and VCT as well, probably passed me by, but it was subject to a sunset provision in 2025 where they look to either say, do we continue or not? That was extended until 2035, which certainly gives some comfort that certainly the current government intend to keep EIS and VCT going in the longer term. So they will continue as we go. Next slide, please. So no change here. I think those who joined us for the budget for the back in March, these are already trailed there. We're fixed until 27, 28 is the current intention, and what we're talking about in terms of stealth taxes as those rates, as our income rises, the allowances we are. And so that's going to flip more people into the higher rate tax, is going to flip more people into additional rate of tax, and sort of current estimates is that going to raise probably an extra 3 billion in revenues a year by 27, 28. We've still got this, I find it still absurd situation where we've got this effective rate of 62%. So those people who go from 100,000 to 125,000, of that additional 25,000, you keep 14.5 and pay 15.5 in tax due to the loss in your nil rate band. So that's certainly the area where you start to look at pension contributions and other things just to see, because it is a very penal rate at that level of income. Next slide, please. So as I had nothing else much to say, I did want to touch upon inheritance tax, which was quite a lot of coverage, certainly in a run-up to the autumn statement, albeit it maybe fizzled out in the last few days as things were put out there which perhaps didn't get the sort of traction or backing which they might have otherwise thought. And I think we'll certainly start to see more, I would suggest, sort of, March budget, and as we sort of move into what's widely expected to be budget year and seeing the manifestos, I think, obviously those things that are commonly talked about and get the coverage are inheritance tax, are the non-dom regime, are the taxation of carried interest at 28%. Obviously, we've had the abolition of the lifetime allowance of pensions, and will that continue or be tightened up? So they're probably some of the areas, well, they're likely to be some of the areas we're going to start to see the whites of maybe the respective parties' eyes in their manifestos as we come up to a general election. But I just wanted to touch upon mainly IHT here, and I'll follow up with a brief poll in a minute, if I may. So you've probably seen the headline, but at the moment IHT expects about £7 billion a year, which is less than 1% of the total tax take at sort of over 800 billion, and sort of about 3.7% of death estates actually pay IHT, which might be just because the value is low, or it might be because obviously there's some exemptions, so business property relief, which can exempt IHT from trading businesses, and agricultural relief from farming land, etc. Also, just death on a spouse, everything that passes to a spouse is free from IHT, capital gains uplift. And so people who are in a position to plan on, someone who does receive something on the death of a spouse and then can start to gift away assets and survive 7 years, again, it can pass through without IHT at the moment in that way. So collect 7 billion a year. The Institute for Fiscal Studies predicted it could collect up to 15 billion in sort of 10 years' time. What we've seen is obviously some voices within the Conservative Party have sort of expressed a desire to scrap it. Some voices within the Labour Party have expressed a desire to increase its scope by either reducing or tailoring the reliefs currently available and so on. So I think at the moment we're in this sort of slight flux. We know what the rules are right now, but will they survive in their current form, come 25, 26 and beyond? And yet much to be seen. My view is still, if you're looking at estate planning, well, I won't sort of lead the witness, as it were. I'd like to come on to a quick poll, if I may, if that will come up. So I just want to say there's been much coverage on the respective parties' potential approach to inheritance tax. Could it be scrapped? Could the rules be tightened and collect more? So people on this, we've got a wide audience here. I've be business owners and individuals. There'll be those wealth advisors and advisors to businesses as well. We'll just be interested to understand approach on current approach on estate planning more generally. And just a quick one of those options there, would you be inclined to push forward right now, knowing what we know on the current rules? Are you more inclined to let's wait and see what the main party manifestos may say ahead of an election? Or do you simply want to wait for the dust to settle post the election and then move forward then? So if you wouldn't mind picking one of those options, I'd be interested in the results. Wow, so that's a very, very evenly spread indeed. And I think it's perhaps what I'm seeing against my client base as well, which is interesting in terms of people are moving forward with well, I think exactly that. Some moving forward with estate planning. Some of those are good to go, but maybe just want to see a bit more what may be coming. And those that are just let's just park it until we know for sure, and then we can move forward there. So thank you for participating in that. That's very, very useful. So I think that's my, for what it's worth, bit drawing to a close. So perhaps I hand back to you, Liam, see if you have any questions.
Thank you very much, Ben. Very interesting. We've had a few questions coming through. We've just been trying to answer a couple of them sort of online because we're overrunning slightly. But if I pick off a couple that we haven't got to yet, there's one which says, can loss-making companies, SMEs, still claim a cash credit to obtain the 16.2 benefit? The answer is they can, but they would do it now under the new merged regime after 2024. I think there's a question around the inflation rate applied to the business rate multiplier. There had been some debate in the run-up to the statement as to whether the September rate of inflation or the October rate would be used. I think it's the September, but we can check that, which of course is the higher rate. Just going down the rest, there's a number of questions around will the recording be made available and the slides, and it will. Everybody who's attended will be sent details of that. I think that covers most of the questions. If we've not got to your question, we'll come back to you individually separately. If we just go on to the next slide. We've got sort of details on this slide of upcoming webinars. There's obviously an awful lot happening, so the details of these will come out sort of with the slides after the event, so put those in the diary. Some very useful events coming up there. And if we could flick through to the next slide again. Finally, on this slide, we've got details of all the speakers. If you've got any questions after the event, feel free to reach out to any of us individually or your usual contact at BDO. I would like to say a big thanks to all the speakers. A lot of effort goes into sort of pulling these slides together under such short time span, and also there's a big team behind us that helps us. So a big thanks to that team as well. And thank you all, and thank you all for joining.